I mean, the whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. But my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, I mean, this is plainly ridiculous. It should be 30 or lower.
Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing the worst settlement.
Andy Schectman, CEO of Miles Franklin, says the recent pullback in gold prices looks anything but normal. Over 5.88 million ounces, worth billions, have been withdrawn from exchanges just this month, continuing a trend that's been building since late last year. What's striking, he says, isn't only the size of these withdrawals, but who's behind them. It began around 2016 to 2017, when central banks started repatriating their gold. Soon after, family offices, hedge funds, and sovereign wealth funds joined in. Now, even major commercial banks are quietly following the same path. According to Schectman, for years this kind of accumulation took place mostly outside New York and London trading circles. But since November, record deliveries of both gold and silver have been appearing month after month, and almost no one in mainstream finance is talking about it. He calls the silence from financial media stunning, given the sheer amount of physical metal being drained from the system. Schectman explains that what looked like a sudden sell-off was likely engineered. Massive sell orders hit the market during thin trading hours, triggering stop-loss cascades that pushed prices sharply lower. That brief moment of panic allowed large institutions like Bank of America and Morgan Stanley to scoop up huge amounts of physical gold and silver at artificially depressed prices. If this had been genuine selling, he says, it would have been gradual and spread out over normal trading hours to avoid volatility. Instead, it was dumped strategically, creating a false sense of weakness while stronger hands used the chaos to quietly accumulate more metal.
You're paying them a 60 basis point management fee. You can store in one of our Brinks facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100, you'd have 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central banks started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this, and at the same time, but that excluded the New York traders all this time until November of this year. And now every month you're seeing deliveries like this of millions of ounces of gold and silver every single month, billions of dollars worth every single month. And again, call it reverse psychology, use it contrarianism, that's a word. Why isn't anyone talking about this on the mainstream? Why do you not hear about the record deliveries? Who's taking billions upon billions upon billions? I mean, keep on going, billions upon billions every single month. Who's doing it? Who's bleeding dry the LBMA? Why is there no talk of this? It is because the lack of journalistic integrity or effort on their behalf to tell anyone what's truly happening, including the people who are trying to decide which way to invest, is ridiculous. And it's just like this pullback that we've seen, right? The mainstream media is all over it. And a lot of the things they said are valid. A lot of them are. It was overbought. It had gone up for 9 straight weeks. It had blown through moving averages. It was in need of a correction. They capitalize on all of that, and then they'll put a cap on and say maybe it's topped and it's over, just like in 2011 and 1980 before that. But what they fail to mention, which invalidates all of it, is that, the snowball that was pushed down the hill to start this going in the access market, when New York was closed, when there were no markets open, before Asia opened, when no trader, Alasdair will tell you, that trader would be fired and shot, and not in that order. Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing yourself, the worst settlement. And then, of course, who did I mention? Bank of America and Morgan Stanley? Well, Michael Lynch says they came right in and scooped up physical, shows the numbers, and silver went right up. So this is all a game that is being done for maximizing the effect, the fear. And there is not one rational trader on the planet that would do that, would dump it in the access market. They would dump it over hours or days, slowly bleeding it into the system, not telling these traders how much they want to sell, slowly, so that the demand would be commensurate with the supply. But they fail to tell you that. They should have said all of these things are true, but they dumped it. They dumped it when there was no market open. So everything they say is invalidated. And all the sell stops that triggered, freaking everyone out, getting all what's going on with gold, what's going on with silver. They never called when gold was going up for 9 straight weeks in a row. And I think the powers that be understood we were entering a period of time where the public was waking up. That's a bad thing when you have a wicked short position. It was damage control. It was short covering. It was fugazi. And you'll see it right back up, I promise you, before the music stops. If this had been done the right way, slowly bled out over days and weeks in New York trading, I'd be less confident. But any idiot, stupid idiot that would dump it like that when there's no traders, well, that invalidates everything that the media said, no matter how rational and logical and valid those statements may be otherwise. That's just my 2 cents.
Well, I actually want to just pick up on an earlier point you were making, Andy. The largest mine in the world is COMEX, because this year so far it's delivered around about 1,200 tons. That's three times China's total gold mining effort, annual effort.
There you go. And who is it? And why don't we hear who it is?
Well, that's for us to guess, isn't it?
Massive credit bubble. Years of easy money and excessive lending, he says, have inflated asset prices to levels that simply can't be sustained, especially in the stock market. The surge in the S&P 500, Macleod argues, isn't a reflection of real economic strength. It's been fueled by liquidity from central banks and aggressive commercial lending. But once that credit expansion begins to reverse, the air will come out quickly, and the fallout will reach nearly every asset class. In times of crisis, investors don't sell what they want to, they sell what they can, just to survive. Even gold mining stocks, he notes, could be caught in the first wave of liquidation as panic takes hold. The key difference, however, lies in ownership. Most investors still lack physical gold or silver. When the credit system starts to crack, real metal, held outside the banking network, will become extremely scarce. That's when prices will reset sharply higher, driven by true supply and demand rather than paper speculation. We're nearing the end of the fiat era, Macleod cautions. The transition to what comes next will be turbulent, marked by extreme volatility in markets and currencies. The best defense is simple. Own tangible assets, not promises. Real gold, real silver. Don't forget to like, subscribe, and share it with other investors who are paying attention. Thanks for watching.